The implication of the floods for the Australian growth profile, of course, is still quite uncertain. The government will be releasing some of its formal estimates on the damage in the next few days. We produced a paper a few days ago suggesting we thought total damage would be about $13 billion, about $8 billion in infrastructure, that's road, rail, bridges, etc., and about $5 billion in housing. That will be the damage. Of course, in addition to that, there'll be lost production and lost activity. The lost production and lost activity, we think about $4 billion, about half of that will be lost coal production, the other half agriculture, services, etc. In terms of the impact upon the growth profile for the economy, we're expecting the economy to contract in the first quarter of this year, but as the rebuilding program gathers pace, that'll provide an additional boost to the economy. So about $13 billion spent over a couple of years will mean stronger growth from the middle of this year relative to what we thought would have been the case. And for instance, in the second half of this year, whereas we were expecting annualised growth pace of about 3.5, we're now looking at 4.5. So the general perspective will be weaker growth in the first half, but stronger growth in the second half. Now, of course, that has implications for interest rates. The Reserve Bank raised rates, as you recall, in November, and that was met by further rises from the banks. Now, we expect that the impact, the follow-up effect of the banks is going to mean the Reserve Bank will leave some time before they decide to raise rates again. But the growth boost that's being given by the rebuilding program, plus the big boost we're now starting to see coming from the surge in commodity prices, is going to put further pressure on interest rates. The market has been expecting one rate hike this year. That has been our call and that remains our call, but there are huge risks now to the upside that the Reserve Bank will run out of patience and raise rates further. Now, of course, the implication there is that it will be exacerbating what we call the two-speed economy, because consumers, households and that have been hit pretty hard this year with rising interest rates. The variable mortgage rate has gone up from 6.65 to 7.8% this year, and we're seeing pretty weak credit growth both in business and housing. But of course, a dominant external sector. The two-speed economy is the big issue. There's a big policy issue for the government. Now, of course, that two-speed economy is very much showing up in the share market at the moment. If we take a longer-term perspective on the share market, we notice that the US market over the last 12 months is up by 17%. Since the low point in July, it's up by 23%, but the Australian market's only up about 1% over the last 12 months and about 13% since the low point. So we have significantly underperformed that US market. As you're aware, the three major sectors of the market, being consumer, discretionary, the banking sector and the resources have more than reflected the strength in the US economy, with since the low point up 28% and up 13.7% over the year, but it's been dragged back by the banks. The banks are actually down on a year ago, down 4%, and only up 10% from that low point in July. And that, of course, reflects that theme of that two-speed economy. So going forward, my view is that US market is probably going to start to come back to the field as all the good news starts to fade away. But for Australia, we still can't lose focus on what's happening in that resources sector. The base metal prices, the Westpac's commodity price index is up 45% from its low point in the middle of the year, and now we're seeing iron ore prices up by 55%. That is probably still not being reflected in those resource stocks, which are only up 28% from that midpoint. So I have to say that I'm quite optimistic about our resource sector, but those other sectors, the banks and the consumer sector, are going to face the headwinds associated with this this two-speed economy that's really starting to emerge in this country, and something that the Reserve Bank is going to exacerbate with further interest rate increases. The big issues facing the world economy over the next 12 months are, firstly, will this recent momentum that we've started to see with the US consumer be sustainable? I doubt it very much. I think the consumer is still very much focused on paying down debt. We've seen little improvement in the US labour market. The unemployment rate's stuck above that 9%, and the housing market is still showing limited signs of recovery. So I don't tend to share the optimism that the market in particular has about the US economy at the moment. As far as China is concerned, we remain very optimistic about China. We think it will deal adequately with its inflation problems, which are really only a food supply story rather than a core inflation issue. And so we're comfortable to think in terms of very high single-digit growth rate for China this year. Europe sits there as the uncertainty. In terms of its impact upon global growth, I don't see it as a major swing factor, but there's the potential for some very, very, very nasty news to come out of Europe, potentially restructuring of Greek and Portuguese and Irish debt, potentially Spain being unable to fund itself in the markets, which would mean that another rescue package would be required, because the current rescue package that's been put together in Europe is insufficient to cover a potential collapse in Spain. So there are big question marks about Europe. It's not going to be a global growth story. It's going to be more a global financial market risk aversion story, which will affect confidence in the Australian economy and in Australian markets.